Hey, what's up, guys? It's Sorunke here. Wow, what a crazy week we've had so far. So, just yesterday we had the November CPI report, and now today we just had the FOMC meeting with the summary of economic projections as well. So, let's do a quick summary of what happened during the meeting and some of the more important parts of the summary of economic projections that we just got today. So we did get the 50 basis point hike that we were expecting. For the most part, the market believed that this was going to happen, and there was very little doubt that we were going to get anything higher or lower for this meeting. But during this meeting, we also got the SEP as well, the Summary of Economic Projections. And this is I guess you could call it quarterly summary of where the Fed thinks the economy is moving. So we'll get things like their projected Fed funds rate for the near future. We'll get their PCE, their projected PCE readings, which remember the PCE is the Fed's most favorable way of measuring inflation. We get things like the unemployment, their prediction on unemployment and GDP growth as well. So starting with the Fed funds rate, the market priced in a terminal rate of about 4.8 to 5%. This is the rate where the market is expecting the Fed will stop their interest rate hikes. In this SEP, we got a median number of 5.1% for 2023 in terms of the terminal rate, which is slightly higher than expected, but it's still very close to what the market was predicting. And this is an uptick compared to what we had in the September SEP report. So it's not surprising. A lot of times, these reports do get the numbers do change over time as more data comes in. So it's not too surprising that we are getting higher numbers than what we got in September's report. But anyways, then in 2024, the Fed does expect to do about 100 basis points or 1% of rate cuts. And then for the range of the terminal rate, it was between 4.9 and 5.6%. So even though the median was at 5.1, you could definitely tell there was a bias to more of the ups. You can definitely tell that there's more of a bias to the upside on the terminal rate, and I believe that about 7. So out of the 19 participants in the survey, about 17% of them predicted terminal rates that were going to be higher than 5%. So it does open up the door to an additional rate hike that the market probably wasn't pricing in before this meeting. And we did see the market move down because of this data that we got. So when it comes to the PCE predictions, there's a small revision to upside in both core and non-core predictions, but it's still guided to be about 2% in 2025. So overall, there wasn't really much change in that. When it comes to the Fed's unemployment expectations, they also moved up as well. And I believe that the Fed predicted a 4.6% unemployment rate in 2023, which is drastically higher than what we have this year at about 3.7%. And they expect that 4.6% to hold into 2024 as well, and then in 2025 it'll finally start dropping. So the unemployment numbers were pretty interesting. When it comes to GDP growth numbers, this was very important. We saw the median read for the 2022 adjusted up from 0.2% to 0.5%. Whereas the 2023 reading was moved down from 1.2% to 0.5%. And to me, this signals that we may see a recession in 2023 as the full effect of the Fed's policy actions do hit the economy. Because remember, there is a lag between what the Fed does and what actually is going on in the economy. But we'll talk more about this later. So moving on to the meeting, Jay Powell started off the meeting acknowledging the lag effects of policy change, and this is the reason why the committee decided to go with 50 basis point hike for this meeting. And he also stated that the FOMC did not want to prematurely start beginning to loosen monetary policy until they had substantial evidence that they could reach their 2% inflation target. So in the Q&A section, Jay Powell was asked about the recent softening in monetary policy. We have over the past about month or so, we have seen yields start to fall on bonds. We have seen the stock market move up quite a bit. We've also seen mortgage rates come down from their highs as well. And Jay Powell responded by saying that this is the reason why they felt like more tightening is needed, because they want to keep that pressure on the economy and not cause premature loosening. So he was asked about the 75 basis points worth of expected increases in 2023 that was outlined in the SEP. And Jay Powell responded by saying that the rapid rate increases that were necessary at the beginning of the tightening cycle isn't as necessary as it is now. And now it's more important to figure out what level they need to hold at. And then he went on to talk about the three buckets that the Fed's looking at. I have talked about this before in previous videos. There's goods inflation, housing inflation, and PCE core numbers. So he did mention that good inflation is coming down with the easing of supply chains. When it comes to housing inflation, he did talk about how there is a backlog due to rent increases that need to be pulled forward, and we probably won't see this start to cool off until middle of next year. And then with the PCE core number, he said that it's the upwards pressure on that number is caused by the labor market, which he expects will take some time to soften, because there is a lot of companies out there that have had such a difficult time hiring. They're not really willing to let people go just yet. But the hope is that as economic conditions deteriorate, these companies will be forced to let go of these employees that they have, or some of the employees that they have, which is very unfortunate. But that is the nature of getting inflation down, is that there has to be some level of human suffering. It is very unfortunate, but that is kind of how it goes when it comes to getting inflation under control. So when he was asked about the SEC projecting an increase in 1%, a 1% increase in unemployment, but no recession. This one was pretty interesting because Jay Powell actually got pretty defensive here. And he said that the 4.7 unemployment rate is still a strong labor market. And you follow that up by saying that the Fed believes that due to tight labor market, companies will hold employees longer, kind of like I said earlier. But they will be forced to be laid off at some point. But this process may take some time. So when he was asked about the possibility of rate cuts in 2023, this again was a pretty interesting question. Jay Powell's answer was pretty interesting. He kind of tried to sideswipe the question a bit. He said that rate cuts will be considered once they see substantial progress to their 2% inflation target. And he did confirm that there was no rate cuts scheduled in the SEP for 2023, which this is a little interesting because the market is pricing in rate cuts for 2023, a little bit more of the back end, like late Q3, Q4. But anyways, we'll get into the market's reaction to all of this later on. So he was asked about some of the recent data points that we have gotten, given confidence that inflation is coming down. He said Jay Powell did agree with this and stated that it does show downwards movement in inflation, and it gives the Fed some confidence. But the Fed feels like they need even more evidence that inflation is coming down before they make any massive policy changes like stopping rate cuts or even cutting rates. And then Jay Powell was also asked about the Fed possibly loosening their 2% target. And again, this was another one where Jay Powell got really defensive and said, like, no, there's no way that we're changing our 2% target. Then when he was asked if he believes that we could still have a soft landing, he did say that the window is definitely getting narrower as inflation stays elevated, but he does believe that it's still possible. He also said nobody knows if we will get a recession. And that's interesting because in the previous FOMC press conferences, he has said that he strongly believes we will not have a recession and that we will have a soft landing. So this is a pretty big pivot on Jay Powell's language when it comes to recessions. So I don't know how much a recession is unavoidable because, I mean, when we look at the SEP numbers, they just increased their projection for GDP this year. And then for next year, they just decreased it, which gives more room for there to be possibly negative readings. So that makes a lot of people think that we may get a possible like Q1, Q2 negative GDP readings. And if we do, that will probably force us into a technical recession, kind of like what we had at the beginning of this year with Q1 and Q2, both being negative until I believe Q2 was revised upwards. The market overall at first, once the SEP was released, they did seem to react negatively to the SEP. But during the conference, the market did start to react more positively. But really, overall, the market was just flat. So this was almost like a non-factor overall. The market overall, at first, once the SEP was released, they did seem to react negatively to the SEP. But during the conference, the market did start to react more positively. But really, overall, the market was just flat. So this was almost like a non-factor overall. It almost seems like Jay Powell and the FOMC is kind of being hawkish just to keep financial conditions tight. But the market doesn't seem to really be buying it as yields actually moved down for the day, as well as the flattish stock market that we got as well. So that was pretty interesting. It kind of seems like the Fed is like kind of playing a game of like BS, like, oh, we're gonna go out there and we're still gonna continue hiking, yeah. And the market's like, yeah, dude, whatever, you're full of it. But yeah, so when it comes to the path of future rate hikes, so it seems like we're probably right now we're sitting at 4.25% Fed funds rate after the 50 basis point hike we got today. So it seems like pretty much the game plan is that we're due for 2, if not 25 basis point rate hikes. And from the language that Jay Powell is using throughout the meeting, it seems like that's kind of their plan, is to continue with the 25 basis point hikes. And I think the only way that we're going to get off, we would probably get anything higher than 25 basis point hikes, is if we do get horrible CPI reports in January, February, and March. And one thing to remember is that the next FOMC meeting is at the beginning of February. And between now and then, we have one CPI report that we're going to get. But between that February FOMC and then the March FOMC meeting, we're actually going to get two CPI reports. The one for January and February. I think that's, if we still continue to keep getting good CPI reports and good inflation data, I think that's when we'll finally see the Fed pause on their rate hikes. Because at that point, they'll have substantial evidence that inflation is coming down. Yeah, that's basically all I have for you guys today. Thank you so much for watching. I'll see you in the next video. Peace.